Hello and welcome to Real Education. This week we're talking about mortgages and specifically what it takes to get an approval. Today I have with me our trusted lender, Bryan Campo with Aamtrust Mortgage. Bryan, thank you for coming. Let's just jump right in.
I work with Aamtrust Mortgage in Clifton Park. I've been in the mortgage business for 16 years. I've been on the banking and broker side of mortgages. I've been in the broker side for the past 3 years. The difference between the two, when you work for a bank, you're pretty much stuck to the bank's products of lending, conventional FHA mortgages, where on the broker side I have the ability of different products. If a borrower doesn't fit one bank's guidelines, I can go shop around to another bank.
Oh wow, that's interesting. That's fantastic actually. So what does it take to get a pre-approval?
Pre-approval, great question. Some people call it pre-approval, pre-qualification. It's one of the same thing, the interchange terms. Pre-approval is basically important for three things. Buyers, they want to know what they can afford. Okay, so when they apply for a pre-approval, they're going to find out how much they can afford. I'm going to look at their financials. So that gives them a budget on what homes to shop when they go around with you to look for homes. Two, agents like yourself, realtors, they want to know, that the people that they're working with are not wasting their time. Time is money in this business. And you want to know that you're showing homes to people who are qualified.
Absolutely.
It's important because as a first-time home buyer, most first-time home buyers don't know anything about the process. They don't know what a monthly payment would be. Sometimes they just think it's principal and interest when, you have taxes and insurance that you have to account for in the mortgage payment. So that's key.
That's great. Now, what documents do you need to get a pre-approval? So my buyers ask me this constantly, and my words are, call Bryan. So if you can elaborate on what that specifically entails.
There's basically three types of borrowers. Borrowers who are on salary or hourly. So it's easy. You get pay stubs, W-2s from the last 2 years, two most recent pay stubs. Clients might be self-employed.
Okay.
Whenever you hear the word self-employed, you always know that tax returns are needed for self-employed people.
I know this.
And the third is people who are on fixed income. So they might have pensions or on Social Security. Those are basically the three types of documentation that people need to submit to me to get the pre-approval.
Oh, perfect. Alrighty. And how long is that approval good for?
Pre-approvals, that doesn't necessarily have a set time, but I like to say 30 days.
30 days?
And reason being, a lot of things happen within 30 days. You might not find your home right away. You might, I always recommend clients don't open up new cards, credit cards, car loans, and stuff like that, because that could affect the pre-approval down the line. Credit reports are generally good for 90 days.
Right.
And it takes about 60 plus days to close on a home.
Okay.
So the last thing you want to do is, have a credit report expire at the end of the process, and that could kill the deal. So I like to keep pre-approvals within 30 days.
Okay, perfect. What is the general credit score that somebody needs to obtain a pre-approval? Because we know that's the big question, because everybody knows when you're getting any type of financing that you need to have your credit in order. And what specifically does that look like?
Generally 640.
Okay.
I deal on the wholesale side. 640 is the minimum that we can work with. Can you find somebody with 620, 600 possibly? There might be people out there.
Okay.
Clients will be paying for that in the interest rate if they do find those products. But it is out there, so I would say generally 640 or above.
Okay, that's perfect. That's actually great, because most people think it's much higher. Debt to income ratios. What is a debt to income ratio, and what do they need to be at in order to gain an approval?
Okay, without trying to bore you too much.
Okay.
Debt to income ratio is basically, there's two ratios when you're dealing with qualifying for a mortgage. One is called a front end ratio, where it's just your mortgage payment compared to what you make on a gross monthly income per month. Then the other ratio is your mortgage payment plus all the debts on your credit report. Okay, so then when I do my calculations, basically you can do it at home too, to figure out what your gross monthly income is before taxes. All right, it's harder to do when you're self-employed, but when you pay stubs, W-2s and on salary, take your gross monthly income, cut it in half, that's 50%, and that's basically what you're allowed for your mortgage payment and all your bills on credit.
What do those ratios typically need to be to gain approvals?
I will go off of the easy scenario. There is different type of debt to income ratios by the book where you need to be, but in this day and age with the way we underwrite files, conventional, you want to stay under 50% debt to income ratio. Okay?
So you have to have 15% of your income that's liquid?
50%.
50%.
50%.
50, okay.
So if you make $8,000 per month, okay, gross, you can go up to $4,000 for your mortgage payment and all your bills on credit for
Okay.
conventional.
Okay.
And then you get to FHA. FHA is a government loan. It's a little bit more liberal. I can go up to about 56.99%
Okay.
for debt to income ratio.
Right.
VA is the most liberal out there. That's for veterans.
Yeah.
I've seen VA loans go up to 70% debt to income
Really?
ratio.
Okay.
So it's a very good loan for veterans who are just starting out and we have
Yep.
a lot of student loan debt,
Gotcha.
so on and so forth. USDA, it's a good loan. It's very tough to qualify.
Yes.
Very strict.
We've been there.
There's a lot of income restrictions. There's a lot of property eligibility restrictions.
Right.
And the debt to income ratios, there's really not a lot of room to work with. You generally want to stay at about 40 to 43% for debt to income ratio.
Gotcha. Okay. So that one, and for some of you that don't know, most of the other property loans have, somewhat of a down payment. USDA is one of those where it's only made for those people who absolutely need 100% financing, and that's why there's so many of those regulations. You have to have the right debt to income ratio, the perfect house, and trust me, I've searched, we've done a couple of them, and ultimately they also take, significantly longer?
Significantly longer because not only does the lender have to approve the file, but it also has to go to the USDA field office for final sign-off.
Gotcha. When someone's credit gets pulled, does it affect their credit?
It's a great question. I've been getting that for 16 years. Probably 20 times a year. There's things that you read online. Don't run your credit. Don't run your credit. I mean, you're shopping around for the biggest investment of your life. Okay? And you're generally not going to go to the first person you see,
Very
whether
true.
you're buying a house or a car, to be honest. So if you have excellent or good credit and you know you have good credit, having a lender or a broker like myself pulling your credit, it's something that's necessary to give you the right figures and quotes. But if you pull it the first time, it's called a hard inquiry, and it goes down maybe 1 to 2 points. I don't think there's an algorithm out there that anybody really knows what it goes down. But let's say 1 to 2 points. So if you're at a 780 FICO score and it goes down to 778 for that 30 days, you have those 30 days to shop around, and it will not be affected again after that first pull.
Okay, all right. Because that's the big question, is because a lot of, especially our first-time home buyers, they are very concerned about making sure their credit stays absolutely perfect to obtain the best rate, the best loan, because they know that's what we've all been taught is make sure your credit doesn't get pulled. So that's something that, thank you so much for answering. What are closing costs?
Closing costs. It encompasses a lot of things in the transaction. We're in New York State where we do our business.
Yes.
So whether you're buying a pack of gum, cigarettes, gas, everything's expensive.
Yeah, just a bit.
So on the purchase transactions that we have tax, state tax, mortgage tax, we have title insurance, we have escrows, we have attorney fees. So there's a lot that encompasses closing costs in New York State. And the big one is that people don't realize it's not really a cost, but it is prepaids. Okay? So when you buy a home, you obviously have to pay taxes and insurance on the property.
Right.
So at closing, what happens is the attorneys figure out how much the buyer has to prepay at closing to put in an escrow account, they call it.
Right.
Okay, so if your property taxes are, let's say, $10,000 on the property, okay, the attorneys are going to figure out how much money they have to hold of that $10,000, okay, to put in an escrow account. So they'll figure out when your first payment's going to be due on that new mortgage, and when the next time the tax bill is going to be due, they have to account for all that money. So when the tax bill is due, there's enough money in there to disperse to the tax collector.
Okay.
So when that number, 10,000, sometimes they can hold 8 months worth of taxes.
Okay.
So you're talking about $7, $8 grand that you have to come to the table to prepay your taxes. That's only a portion of the closing cost. Then we have to get into detail about mortgage tax, title insurance, and all that good stuff.
Oh, beautiful.
Property taxes on a pre-approval, I like to tell Jason and any other realtors I work with, when I see the debt to income ratios are tight, if you're looking at a property with $4,000 in taxes, and
Right.
you fall in love with a property that's $8,000 in taxes, that could be $400 a month different in payment
Right.
for those taxes. So that could affect the pre-approval. So I always tell Jason and any of their clients that I work with, send me the addresses of the homes so I can get the tax bill, and then we could update the pre-approval.
Right, because those taxes get paid over 12 months versus your principal and your interest that gets divided over 360 payments, typically in a 30-year mortgage.
Quick little math here.
Mhm.
Roughly every $5,000 in difference is about $20 in payment.
Okay.
Okay, so you go up 5,000, 10,000. You like that house for 20,000 more than what you think your budget was. That's only $40 in payment for a 20,000 higher house.
Yeah.
Purchase price. For taxes, you go from 4,000 to 8,000. That's $300 a month, $400 a month. It's a big difference. So taxes play a key role.
Absolutely.